So I want to take just a minute to explain what we're referring to when we use the term blended interest rate. Now, many times if you're putting down less than 20% or you're doing a government loan that's not a VA loan, then you're going to be subject to a monthly mortgage insurance premium. Now, some people call that PMI, and I know that has a negative connotation in many cases, but it's really not as bad as what most people think when you think in terms of how low interest rates are at the moment, and also take into consideration how you make your payment. If you send in more each month on a PMI, on a conventional loan, it could go away much faster. Now, government loans, for example, like USDA and FHA, they have monthly mortgage insurance premiums as well because they self-insure those loans, and they're set premiums, and it really depends on when you got the loan to begin with. So in 2013, FHA or HUD decided that they were going to make that mortgage insurance permanent for the life of the loan. If you had a 4% interest rate, as an example, and you add the 1.35% of whatever it was that you financed, and you divide that by 12, that is how that calculation is derived. And then you that part of the payment is with the loan forever. So while 4% sounded great, and quite frankly, it might have been the only type of loan that you qualified for at that moment, the blended rate is actually going to be higher when you take the payment, the principal, the interest, and the mortgage insurance, which are all going to be there for the life of the loan, and compare that to a loan that does not have mortgage insurance. So if you took the same balance, same rate, same payment, same mortgage insurance, then you could really be looking at closer to 5% or 5.5%. Now, FHA has lowered their mortgage insurance premium, which makes it a good time to take advantage of possibly doing an FHA streamline, or your credit might have improved, or the scenario, the situation might have changed, or your equity might have increased, and you could qualify for a conventional loan. Now, the conventional loan mortgage insurance, should you opt for the monthly version, actually goes away at one point at 78% of the original balance, or the original sales price. Where that used to be the case with FHA loans, it's not the case anymore. And this effective or blended rate, while on the surface you may end up taking a payment that's slightly higher, but going from an FHA to a conventional loan that has, quite frankly, more options, and we'll talk about that in another slide. Comparing FHA and conventional is going to be something that you want to take into consideration if it's an option, because long term and short term, it's going to probably end up with a better overall, lower effective rate or effective payment. We're so conditioned to ask for, hey, I want the lowest rate, but in many cases, really what we're asking is, I want the lowest payment, and when I sell the house, I want the most equity. So we're going to compare those options for you, okay?